Happy Thursday out there, Team 42. It's your skipper here, Darius to present our macro minute for Thursday, October 10th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, will U.S. inflation data continue to support Jay's soft landing agenda? Will Q3 earnings season justify record highs in U.S. stocks? And with China's upcoming fiscal stimulus announcements to disappoint investors? Our answers are the September CPI report featured upside surprises and sequential inflation, supporting our sticky inflation theme in the process. These upside surprises are likely to be dismissed by both investors and Fed officials due to transitory factors. It's our next 12-month outlook for inflation that should have investors concerned about the bond market. All told, we continue to observe evidence of sticky inflation in the U.S. economy. We do not believe sticky inflation matters to asset markets until the Fed officially downgrades the labor market in its reaction function. Given that the median FOMC member believes the neutral Fed funds rate is all the way down at 3%, and Chair Powell's latest guidance at the NABE conference, investors should expect the next 100 basis points of cuts to be mechanically pushed through over the next 4 meetings through March 19th, irrespective of what inflation data signal. The bar for Q3 earnings beats is low, and investors should expect China-centric assets to respond favorably to upcoming stimulus announcements by the China's Ministry of Finance. Transitioning to our 42 macro dashboard, as always, we'll wrap up with a question from our community. This one's regarding the bond market. It says, hello, Skipper. In your morning note, you mentioned that it is the near-term outlook for inflation that should have investors concerned about the bond market. We actually didn't, so I will clarify that in the answer. Can you expand on that for us for a little? Should we expect that bond yields on the long end have gotten too high and to revert down quickly? So everything in this question, no offense, is wrong. The question is, the answers to every question is no, no, no. So we are not concerned about the near-term outlook for inflation as it relates to the bond market. We are concerned about the next 12-month outlook for inflation as it relates to the bond market, because our model is calling for CPI to grind higher over that time period and inflation to generally and persistently surprise to the upside over the next 12 months. As we talked about in the executive summary, we don't think that matters until the Fed realizes that and downgrades the labor market in its reaction function, which will, by definition, upgrade the inflation, the price stability aspect of its mandate, of its dual mandate. And by the way, the Fed doesn't have a dual mandate. It has 3 mandates: financial stability, price stability, and maximum employment. And as we've been talking about in our research, going back to November of last year, financial stability and maximum employment are much more important to the Fed than price stability. And that's something we expect to continue over at least the next couple of quarters. Should we expect that bond yields on the long end have gotten too high and should revert down quickly? No, we expect the exact opposite of that. In fact, go back to this time last month, we were calling for investors, we were calling for the top in the bond market, very explicitly calling for the top in the bond market because of our, sort of relatively hawkish next 12-month, nominal GDP upside surprise view. And that's something that, we continue to see. We've gotten confirmed by the first batch of data since then, and we expect to continue to be confirmed by the data. So, kind of summarizing everything, we continue to be, generally sanguine with respect to the, medium-term outlook for risk assets, due to a confluence of factors, not the least of which we are expecting nominal growth in the U.S. to surprise to the upside. We're anticipating the Fed to continue to support our here comes the liquidity theme, which is creating scope for China and other central banks around the world and policymakers around the world to continue to support rising global liquidity. And ultimately, we expect a very positive dynamics for U.S. liquidity starting in Q1 of this year. So it's a lot of bullish things. It's a lot of bearish things. There's a lot of cross currents in global macro right now. So in our opinion, you have to be really focused on what are the first principles drivers of asset markets, and more importantly, understand how to weight those things in the context of all the various cross currents that we're observing. It feels like we're starting to get towards the latter innings of a bull market. I don't think we're there yet, but I do believe that, maybe this time in, let's call it 4, 5, 6 months from now, we're probably getting very close to the tail end of this bull market that began back in the fall of 2022. So we'll wrap it up there. Darius presenting our macro minute for Thursday, October 10th, 2024. Best of luck out there today. We'll catch you back here tomorrow. Cheers.